So hello everyone, it's great to be back here on the stage today and talk to these great VC investors and also Eva from STARTUP Estonia. I'm Sille from SmartCap. This is a government-backed venture capital fund in Estonia, investing mainly in VC funds, but also in green tech startups. And I'm gonna give the word to our panelists to introduce themselves, a quick round of introduction so you know who is who and where they invest in. Eva, first you, STARTUP Estonia.
Yeah, hello everybody. STARTUP Estonia is a governmental program to develop the Estonian startup environment, taking care of talent, available services, regulations. So that's us before any of the VC action will happen.
Troy.
My turn? Okay. Hi, I'm Troy Weeks. I'm a partner at McWin Capital. We manage about €1 billion under management across 2 strategies, food service and food technology, and 3 funds. We like to play at the intersection of food service and food technology.
Gerri.
Hello, I'm Gerri Kodres, and I'm a founding partner of Specialist VC. Yeah, I've been involved in investing to Estonian and Baltic startup space for over 12 years, and last 5 years I've been involved with funds. Right now we are in our second fund, and it's a 50 million fund focusing on the Baltic, mostly pre-seed and seed phase, sometimes round A.
Hello everyone, my name is Charles. I'm the founding partner, one of the founding partners of Ace & Company. We are a private equity and venture capital investment firm. We manage a total of 1.6 billion. 400 million are being invested in venture over the last 15 years now. We invested in more than 150 startups globally. And while this is my first time in Estonia, I had the privilege of backing 2 of your unicorns. Namely Wise and Verif, and I missed on other few, so I'm quite excited to be here and be able to interact with all of you today.
Thank you. And in case you didn't notice, we have a few billion euros worth of venture capital sitting on the stage. So if you have any questions, use Votema and put it out there to see what they think and how they invest. But before I begin, I go back to yesterday when I was talking on the stage about how the market has been for the past 10 to 15 years, how we have seen very good times, extraordinary good times, and what sort of shift we saw on the market last year. We saw increase in interest rates, money getting more and more expensive, also for venture capital investors. We saw increase in prices, every kind of prices, from energy to raw materials, and also a lot of push for the salaries still. And this has reached the venture capital scene and market. Has it? I mean, I want to start with a question. Has it reached, or how has it affected venture capital investment scene in Europe? Troy, do you want to start off?
Do you want to throw me in the deep end?
Yes.
Okay, good. I think the short answer to your question is yes, it has. The longer answer, I guess we've got 30 minutes to explore. But look, you have to remember that venture capital is a long-term asset class. So despite the short-term headwinds, and I think we're seeing the short-term headwinds in front of us all, it is a long-term asset class. We invest in long-term sustainable trends, not short-term fashion. And so I think one has to take a step back from those short-term headwinds and understand the nature of this asset class. It's anyone who tells you they can time the market is lucky or lying, or both. The data is really clear on that. So we take a view that trying to time the market's a very difficult thing, and we have to therefore adopt a strategy that's premised on long-term sustainable investment strategies. We've placed our chips in terms of what that means, those long-term tailwinds, those long-term trends. We're invested in food and food technology and the long-term sustainability of the food ecosystem. We know just how broken that is. I think, both COVID and then subsequently the war has laid bare some of those challenges within the food ecosystem. And that's where we've, placed our chips and where we want to play for the next period. There's a lot of work to do around that. So we really look at this as a long-term thesis. That's not to say there aren't challenges in the short term, and we can explore some of those, I think. But we're investing for the market in 5-6 years. We're not investing in the market for today. I think we saw during the financial crisis the average holding period for companies in this region. If you look at the data from EBRD at the time, it went from 4 years to nearly 8 years, 7.5 years. So we saw a nearly doubling in terms of hold periods for companies. That means there's a lot of work to do with those companies. And the market that we're selling into, the only thing I think you can be sure of is that Silicon Valley Bank won't be around, right? But beyond that, I think you've really got to put some of those short-term considerations aside and look at the long-term picture. I think we're going to see some of that again. So I think we are going to see some of that extended holding period return. Whether it ends up at 8 years or whatever that number is, I guess we'll find out. But I think there's a lot companies are going to have to be doing in that period to be looking at the sustainability of their models and their financing. And I guess we can dig down a little bit into some of those short-term issues. Certainly, we operate at the growth phase, so we invest at Series B plus or minus. Call it late Series A, mature Series A plus. We're seeing a lot of choppiness in the market at the moment. There are a lot of companies out there that have raised significant amounts of capital at significant valuations, and I think that's now starting to unwind. And that's, my take on that is we've probably got a 2-year period where that's going to have to work itself out. Companies are going to burn through their existing capital. A lot of those companies are going to raise bridge rounds and so on. They're going to continue. So I think that's going to take a couple of years to really play itself out. I think we are seeing quite a few dysfunctional and broken cap tables as a result. I think in some respects, one of the biggest impediments to companies, certainly in growth phase in the current market, is some of those early investors who are really in a difficult position now where they're going to have to take a write-down on their existing investment and think about down rounds. And I think that note of caution is protracting fundraising as well at the company level. And so we are seeing quite a bit of, I think the blood's in the water, in some respects. And there's certainly people looking for opportunities as a result of that. So just a few thoughts.
Thank you. Let's start narrowing down. Eva, what have you seen in Estonian startup ecosystem? Has it somehow reached our startup community? Mm-hmm.
Yes, definitely. It's no news that there have been a couple of layoffs, bigger ones in the world in general, but also in Estonia, because the expectation of the companies to be more effective, to look through their product profiles and the product portfolios, and to really have a longer, let's say, a runway in case stuff happens with the investments coming in case the deals go slower than expected. But in general, towards the end of the year, like when we see the numbers all together, the number of employees actually increased by 22%. So I don't know if this is something unique for our country, or it's just that the sector itself is built for resilience. It's just in the DNA, and startup sector is growing still, and it's still the biggest, startup country in the EU. I don't want to be overly optimistic, but as far as 2022 goes, with a little ripples on the water, it's really turned out a great year.
Thank you. Troy, you mentioned that we're in the long-term game, or it's not something very short perspective. I want to explore a bit more on that way and explore the long-term strategic plans in current market environment. Charles, are you willing to open what kind of investments are you looking at, or what do you focus on for the next 5 years? Because most of the VC funds have 4 to 5 year investment period. So they set the sight for the next 5 years in order to get return in 6 to 10 years. Charles, what's in your focus for the next 5 years to be winning in 10 years?
So obviously there are mega trends that we also follow, and we try not to be diverted too much by the immediate fashions, even though it's always hard to sort between those opportunities. But no, I think there are mega trends at play. Whether if you look at themes such as climate tech, I think that's pretty clear. I'm a big believer in the continuous disintermediation of some services. If you look at fintech, and I think a country like Estonia is at the forefront of that. So if you take some of those big themes, which have been the same, to be honest, for quite some years, I think you can continue to invest in those. And what hasn't changed, at least for the early stage investor that I am, is you focus on teams. You focus on really the quality of the people, and so honestly, I think it's a great time to invest, especially in Europe. We are now facing a return of risk, as we discussed. But I remember when I started about 15 years ago. I mean, Europe was nowhere really on the map. I mean, you had Skype, that's it, really. I mean, that was the only success story that came again and again across every single pitch deck. I think now you have real global winners everywhere in Europe. Maybe some unicorns are overvalued, and yes, they need to be some re-rating here and there. But I believe what's exciting today is the fact that you have those platform companies, or as I like to call them now, mafias, that get redeployed into other sectors. And when you look at what has happened recently, you can be very confident that some of the most successful entrepreneurs in Europe now are starting the second or third companies, or even becoming investors of their own. So, in terms of, I think, depending on which themes you focus, but there are still very large trends, and I think that the talent has never been as good as today.
You mentioned it's good time to invest for you. Can you elaborate a bit what your investors expect from you, or what's their view? My investors?
Yes. Double-digit high IRR on a yearly basis. No, it's tough. I think 2022, if anything, it's been very hard to raise money. LPs are, I think, fearful, and there's a lot of things, different things at play. I think you had an explosion of the asset class, and all of a sudden, the last 2-3 years, everyone wanted to put some chips in venture. But not everyone is necessarily ready to accept or has the risk tolerance for the asset class. Or the patience. I mean, it takes 10 years, as you said. My best investments are still running, and they date back from almost a decade ago, right? And actually, I think you should let your winners run as long as you can. So for the LPs, yes, it's been very challenging. I think the sophisticated LPs recognize that it's during those downturn that you find some of the very best opportunities. And there's, the valuations make more sense today, and you could argue there's probably less competition among GPs to back those companies. So again, that makes me quite confident. Now, what has been really challenging, I think, for any LPs is the necessary mechanical rebalancing of your portfolios. If your public portfolio shrunk dramatically, well, it's hard to justify keeping a very the same proportion within private investments or illiquid investments. So I think it's for us to continue, the GPs, the fund, to continue exchange with LPs and letting them know about the opportunities and maybe also finding structures and terms that indeed make sense for them.
You made a really interesting point there, which was to say sometimes there is pressure from LPs who may not always understand the distinction between fashion and trends and long-term trends, and sometimes it can be very hard to resist the pressure from LPs and from someone in the market to be, why aren't we engaging in a certain space? Why aren't we embarking further in a territory where everybody else seems to be focused? Have you found that an easy conversation in terms of managing those expectations? And do you have to constantly iterate with that message in terms of making it clear that long-term sustainable trends are always going to out-return short-term performance metrics?
So I'll answer very quickly, and maybe Gerri has comments as well. I think we've increased the level of communication for sure, and we feel that in these times, this is when you need to almost over-communicate with your LPs and taking also their feedback, understanding how they feel. But again, what works also in our favor is the fact that we have some track record. We also have some examples that we can put forward. Yep. But it's tough. It's tough resisting the daily pressure.
Do you think LPs understand the nature of this asset class still, or are we still in this phase of...
I think it is, especially in Europe. US has been much more mature in that respect, but I feel in Europe now you have much more sophisticated LPs. I think the asset class is seen as less exotic and more integral part of any asset allocation. And again, it's that almost second generation that's coming to play now, and so it feels less of a cottage and pioneering industry as it did prior.
Gerri,
Yes,
do you think you want to? Did you want to build a resilient portfolio? Or are you also looking for opportunities to meet expectations of your investors?
Yeah. Maybe quickly comment on the last question. So the name of the panel was like in 5 or 10 years perspective, what should happen? And I think for the funds that, like for example, our fund, that second fund started only last year, actually there are quite, in 10 years perspective, there are quite good expectations towards the current vintages. Because maybe it's a bit more problematic when your vintage was like 4 or 5 years ago, or maybe even more years ago, when you might be in the position where you need to start exiting, for example. These might be more tricky situations, but for the funds actually that have started very recently, I think the expectations towards these vintages are quite high, because that's what history has told us, that these type of times have actually generated very good companies, and also the valuations are not inflated, and there is less choice, and all the things that were discussed here before. But definitely in the short term also, for our portfolio, we see that there will be a recession. Like for at least base scenario is that there's going to be a few years recession, and for us as an early phase fund, of course, this means that we need to make sure that the company will be able to raise the next round. Maybe just put it a bit like in simplified way. Then Q3 last year, actually the VCs told often companies that have at least 12 months of runway. In Q4, actually it was that try to have at least 2 years of runway, 24 months. And now basically, whenever possible, we tell the companies that also have a break-even plan whenever possible. So it's actually, that's how the situation has changed. And of course, if you're in a very early phases, it might be difficult. But if you already I see that seed phase companies often have break-even plans just as a backups. So I think that's also what maybe not necessarily break-even plan, but at least we try to also make sure that our portfolio companies have 18 to 24 months of runway. And also what we look very carefully right now is definitely the unit economics when in the previous situations, actually, you could always count that, okay, you know, maybe the company is growing very well, but the unit economics is not fully yet in place, and you know, it was possible to tell a story that it's going to be in place in few years' time. Then right now, it either needs to be in place right now, or you need to have a very short plan for the unit economics to be in place. So that's actually also something that we right now look across the board for all investments that we are considering. Yeah, runway and unit economics, two main things right now that we look at the early phase. Now, of course, in addition to all the, you know, standard criteria, and also preferably when you know, the entrepreneur has shown some kind of a, you know, resilience, or already before our investment has been able to show that they have taken some steps already actually towards these directions. So we don't need to start, you know, like shocking entrepreneur with this, you know, information that actually, you know, like you need to do some cost optimizations and which sometimes can be a bit controversial, because the amounts that the companies raise right now are smaller. At the same time, there is inflation. So as we discussed, although in the maybe the wage inflation in this segment has been less than in other segments, but it's still there, and companies are still hiring. But 50% of the costs are typically other costs than salaries. So these are still raised. So with a smaller amount of money, you actually need to achieve more in the situation where there is inflation and the costs have increased. So really, the companies are not in a simple position. But yeah, we have seen that founders, and especially I think what now also works in our benefit for the entrepreneurs from this region, that even historically entrepreneurs have been more maybe cost optimized and more cautious, and they have not always been able to rely on, you know, having second and third round coming without, you know, much revenues. So maybe this kind of resiliency in this region is what has made it somewhat easier compared to maybe US peers. I think that's generally true of Europe, isn't it? I mean, yes, generally in Europe as well. The sort of revenue per dollar of investment in Europe is I think, you know, known to be a better value proposition in Europe. And I think that presents some really, really interesting opportunities in Europe, particularly around deep tech. I think there's enormous opportunity in Europe. I mean, an enormously broad base of the pyramid at the hard technology level. A core competitive advantage, I would say, of Europe.
And you're seeing big companies taking advantage of that arbitrage on wages versus talent, right?
Yep.
Troy, what kind of regional differences you see, if at all? Global versus Europe versus Baltics, Nordics?
Gosh, well, I think you've named perfectly. I used to have a phrase for this in a previous. I think certainly Central and Eastern Europe, the Baltics, founders are born bootstrapped. Yeah. Really, I think that's fundamentally true. There's just enormous hunger and drive, the ability to do more with less, and I think that positions founders incredibly well, particularly relative to the US. So I think, you know, the capital efficiency, the ability to do more with less is unambiguously, I would say, a competitive advantage. Whether or not that's a long-term sustainable competitive advantage, I'm not sure I would try and build an ecosystem on that basis, right? It's the same as labor cost arbitraging. I personally don't think that's a long-term sustainable competitive advantage. I think you have to build better solutions and better technologies ultimately at the end of the day. But it certainly helps you get further faster in that journey. And I think, you know, so often within the technology space, I think there's an understated degree to which I think often in the VC space, particularly over the last 10 years, where things are dressed up as technology that I think are really just around process advantages and so on. I think technology in some respects is a misapplied and misused word very often with companies over the last 10 years trying to position themselves. But against that background, I think there's enormous opportunity to create those short and medium-term competitive advantages, to get runway advantages relative to other markets. And I think that does matter, whether or not you debate whether that's a technological issue or really just a cost of labor issue or market issue. I think in some respects doesn't matter. We see a bunch of companies that have got 2 or 3 years advantage, relative to some other markets. Just as one thought.
I agree that a lot of the low-hanging fruits have been picked here, but we are in a very good position, or a base case where to build on. Eve, can you share your views and thoughts? How or what's the way ahead? What are we gonna build on, or what's your plan to develop Estonian ecosystem from here on?
Yeah, like it was said, there is a good basis. I mean, the mentality is there, the drive and the hunger is there. I mean, the experience is there, how to build, global, fast-scaling companies. But, necessarily the successes that have happened so far are not the successes of the next 10 years. So definitely we need a paradigm shift, and that takes the cooperation between the government and the private sector. And definitely, us as the governmental initiative, we have to make sure that in order for you guys to have the deal flow in the next 5 to 10 years, not the fashion, but the good stuff, then we need to do the groundwork already now. And actually, we have been doing it for a couple of years now, to really take the, let's say, more difficult road towards the research-intensive technologies. We need the talent for that. We need the capital for that. Well, SmartCap is also looking at that, green funds and deep tech funds. So we need the services for that. So the accelerators or the incubators that existed in 10 years ago are not enough anymore. We need to bring the science teams closer to the investors. We need to bring them closer to the business people, and to really have ways for them to understand each other. So also internationalization. The more we get to the, let's say, technology intensive stuff, the scarce we become in our existing knowledge in Estonia. So we need more ties inside our ecosystem, and also with countries outside, with ecosystems outside. That's why we're talking about creating a, let's say, Nordic Tech Valley, because we have a lot of similarities. We have a lot of the same problems. Of course, we have our different paths in these countries, but what we all agree on is that we have to build better networks between each other to become, a stronger player on the global market. Like you say, you never looked at Europe at some point. Maybe the whole of Europe is too big of a chunk to tackle together, but these regional innovation ecosystems can actually make a difference.
It's an interesting subject because it raises a whole bunch of questions coming out of COVID around how you build teams. And certainly observationally, I would say an area that Europe needs to continue to focus on is labour market mobility. I mean, since COVID, we've seen the ability to build distributed teams across multiple markets, the idea that you've got a team in one location with maybe some development being done in other markets. I think those days, whether they return or not, we'll see, but I think, for the foreseeable future, I think those days are gone, if not heavily modified. So I think from a competitive advantage perspective relative to the United States and some other markets, more work and continuing work needs to be done at the European level and so on to help with labour market mobility and the ability to build businesses simultaneously across multiple markets. That's just sort of one observation I would make since post-COVID.
Charles, I go back to you. What should all the startups know or bear in mind when they fundraise this year or the next year, from you or from any other VC that you think?
Well, they should, of course, be aware of the environment we're in, and what we said earlier about, make sure that you have enough runway, or that you're planning for a path to profitability or break even, because it's true. I think there's not going to be a quick return to growth at all cost. And that's intrinsically linked to where the interest rates are, and that's you can be as optimistic as you want, but it's not gonna revert back to where we've been for the last 15 years. Even though the collapse of SVB has probably also reduced the acceleration in rate hikes. But no, as a founder, I think you also, of course, need to integrate the new technologies, and that sounds very obvious, but I think when you see the efficiencies you can derive with AI, it's not just putting a .ai at the end of your name, obviously, but I think really integrating those new paradigm-shifting technologies to be also more data-driven. I think really using the tools of today, recognizing that we're not working today like we used to work 5 or 10 years ago, and that Europe can play its own cards in this global game. So I think it's always the same, or always, it's pretty much the same recipe whereby you need to start small, you need to start really finding a product market fit. As a famous accelerator said, build something that people want first and foremost, but then really have the global ambition, because that's what we want as investors. We are looking for outsized returns, and you only get there by outsized ambitions. And so I really, and I think this is something that Estonians actually do pretty well in Europe, better than other countries. And maybe because you're a small country and you need to look outside of your borders pretty quickly. But yes, really thinking globally, thinking how you can attract and build the best team. So it's nothing new, but it's I think more of the same, but with this consciousness about where we are on the funding market, and yes, and it's tough. The bar is raised high, but they're still investors, and they still need to find avenues to deploy money effectively. And so if you can emerge at the top of the pack of the entrepreneurs because you've built the best team, because you have the best metrics or the greatest ambitions, you should always be able to find investors to back this.
Mm-hmm. There is capital available on the market. The question is how to find it, where to find these. Gerri, maybe you can comment on that. You have a portfolio of companies. You see their cap tables. You know where they are currently fundraising from, or from who they're fundraising from. Has it changed? I mean, the sources of funding for your startups, and what sort of trends you see there?
Yes. Maybe it used to be a few years back that maybe very heavy R&D type of startups, they turned a lot to non-dilutive financing sources. But now we are seeing that actually quite many startups, and we recommend them to turn to non-dilutive financing sources like grants and all kinds of support programs as well. And this really is something that maybe, you can't neglect nowadays as a startup. And because sometimes it used to be maybe the focus was more on growing the business in the earlier year. Right now it's still in the growing the business, but also it's increasingly on just keeping the runway as long as possible. And non-dilutive financing actually has developed well, I think, in the last year. There have been more and more possibilities available for these, and we see that even the startups that really didn't think about it too much a few years back are now very successful using these sources. And this is one place where state definitely, I think, has done a good job, and where Europe maybe has really worked out good programs. And a lot of these programs, they were worked out during the COVID times. This crisis passed relatively fast, but now actually it's the right time to start using it, and many startups are doing so. That's one recommendation definitely. And the rest is actually really to also, sometimes there are also some other things that you can do, like for example to manage your cash flow, for example to do factoring, if you have long-term payments, to work with the factoring. We have recommended and worked with this type of setups with many startups. So again, it's like so short-term solution, but it helps you to overcome this value that you're right now maybe having for the next few years.
I think they're great comments, and couldn't agree more. I think there's going to be a lot of pressure going forwards to diversify funding sources, revenue-based funding sources, non-dilutive based financing sources. Within Europe, I would observe that there's a little bit of a propensity to fall back on the state with some of that. And I think that's fine in some respects. I think that's potentially a very powerful underpinning to the asset class in the next few years as we get through this difficult phase. I think that opens up a not insignificant opportunity for the private market to come in, and I'd certainly like to see that within Europe, to see the private market develop more aggressively with alternative financing models.
Yes, venture debt actually, which none of our companies really used like 3 years back, right now is very active.
Absolutely. And I think it's a really big opportunity, particularly for new players.
And I hope
this is the very important issue for most of the stuff. They need to fundraise, and from who and how to fundraise might be the sort of the thing where we're closing the discussion, and maybe Charles, you can also comment on that and give your advice on
No, I very much
sources.
second everything that has been said. I think, again, even though we're talking about the current mood that has been changed, but again, if you take the high-level view, there's probably never been as much dry powder in the system, even in Europe. So funds are still there. They still need to deploy. They'll need to convince the LPs that the commitments are warranted and the capital calls are indeed due. But beyond that, I very much agree that maybe the retracting of banking credit opens up opportunities for alternative lenders. I mean, we've seen great neobanks emerging in Europe, and I can tell you that all of them, somewhere in their business plan, have SMB lending or credit on the horizon. So it'll be very interesting to see how they can serve, fellow startups or small and medium businesses. So, no, very much. I think beyond the traditional equity, look for non-dilutive financing sources and maybe alternative credit. Yeah.
Look, the cost of capital is unambiguously going up over the next couple of years. I mean, that much is clear. For how long, we'll see. I suspect for some time, relative to where we've just come from. The venture debt market in Europe is still incredibly nascent. It's incredibly nascent. There's still very few players in the venture debt market. State actors and quasi-state operators like the European Investment Fund and SmartCap and others, there's a big opportunity to play into in terms of those alternative sources of financing and those types of instruments, and building out those parts of the market that are still relatively nascent. And that could be venture debt, still a big opportunity, but there are other models out there as well, and I think that's an enormous opportunity.
Thank you. I hope you get good insight what the investors are investing in, what they're looking for, and whoever wants to approach you off the stage, is your chance in a few minutes, because we're closing this panel. Thank you.
Thank you. Thank you very much.
Thank you. We have just enough time for one more question, I think, from the audience as well. And this is, would you rather look for startups to invest in or traditional companies, and why? That is the question.
It's an easy one for me because I do both.
Okay, both. Yeah.
Also easy one for me, basically, to startups.
What is a startup is a company that can post hyper growth, simply put, and we need the hyper growth to reach the returns that we promised to our LPs. So I'll still focus on startups.
Okay. And we were talking about long term as well here. And someone asked, how long is the long term when you expect to get the revenue?
The long term actually has decreased right now. The time how you consider long term has decreased to some extent. So right now, of course, you expect the revenue to be earned much faster and switch on. Basic pricing models quite faster. You can't afford running like a free service for too long time. So all this is gone basically during the last few years.
12 months feels like an awfully long time at the moment. You know. But, you know,
current environment, you just need to survive for
Yeah.
the next few years. That's often the case with early phase companies.
I mean, the average life of a venture capital fund in Europe is 14 years, right?
Yeah.
I mean, the data on that's really clear. It's a 10-year asset class with a 14-year life. It'll be really interesting to see what happens over the next period to that.
Okay, so long term is basically like the age of pension. Like it keeps going forward all the time. Like this year, no, more work to do.
To put that in context, the average life of a fund is twice as long as the average marriage. So just to,
But also at the
you can
same-
make of that what you will, but that's the numbers.
But at the same time, actually, you can increase your competitive position also during the current situation. Like
Yeah.
we've seen the companies, like Bolt is a good
Absolutely.
example from a later stage company
Yeah.
that during the COVID actually lost a lot of revenue, but recovered much faster than any of the competitors and actually gained market share during this crisis. So if you have a chance, that's also a good opportunity.
Yeah.
Thank you very much. Thank you for the panel.
Thank
Thank you.
you.
Thank you.
Thank you.
Lovely panel.